Hello and welcome back to our channel. Today we're talking about the collapse of Silicon Valley Bank, a tech lender with assets of $212 billion that recently collapsed, triggering the most significant financial crisis since 2008. There are several reasons experts believe that SVB failed. The first reason is Trump-era regulation rollbacks. Bernie Sanders argues that an absurd 2018 law undid some of the credit requirements imposed under the Dodd-Frank banking legislation that was brought in after the 2008 banking crisis. SVB CEO, Greg Becker, argued before Congress in 2015 that the $50 threshold required by Dodd-Frank was unnecessary, and his bank, like other regional banks, does not present systemic risks. Trump said the new bill went a long way toward fixing Dodd-Frank, which he called a job killer. However, the nonpartisan Congressional Budget Office warned before the bill passed that raising the threshold would increase the likelihood that a large financial firm with assets of between $100 billion and $250 billion would fail. Joe Biden says he wants Trump's rollbacks reversed. The second reason is risk mismanagement at the bank. The bank didn't have a chief risk officer (CRO) for some of 2022. A situation that's now being looked at by the Federal Reserve, according to reports. Early SVB shareholder lawsuits are said to be looking at the key vacancy, especially as the board's risk committee was meeting frequently before the bank collapsed. SVB and Signature, the second mid-size bank to fail last week, have also been accused of prioritizing social justice over financial management. The narrative fed into a larger conflict over ESG, or environmental, social and corporate governance-driven investing, that has become a target of conservatives. But the bank's loans to community and environmental projects were not central to its collapse, nor are its diversity, equity and inclusion (DEI) policies dissimilar to other banks. The third reason is inflation and interest rates. SVB had benefited from more than a decade of zero money interest rates as billions poured into the bank via tech venture capital. Looking for some kind of a return, it put the money into long-term U.S. Treasury bonds. But when interest rates started sharply rising last year and depositors demanded higher returns, the bank was forced to sell some of those bonds at a loss. When news of that hit social media, tech investors panicked, triggering a classic bank run. From there, it took 36 hours for the second biggest bank failure in U.S. history to materialize. So there you have it. The collapse of Silicon Valley Bank was caused by a combination of factors, including Trump-era regulation rollbacks, risk mismanagement at the bank, and inflation and interest rates. Federal investigations have begun, and lawsuits have been filed, so no doubt more issues at the bank will emerge. We'll be sure to keep you updated on any new developments. Thanks for watching, and don't forget to hit that subscribe button for more finance news and analysis.